monthly webinar for June 2024. So let me just take you through the performance for all the four schemes to start with. So if you look at coffee can in terms of returns, if you look at the 1 month return, we were at about minus 1.2 versus flat at the Nifty level. But the important point is, if you look at the last 3 months, there has been a significant outperformance. So returns have been about 5.4% compared to 3% for Nifty. In fact, starting June, the outperformance still continues. If you look at the top performers for the month of May, it was led by Havells, Container Corp, Bharti Airtel. Two of these ideas, Container Corp and Bharti Airtel, were new ideas initiated by the new fund manager Siddharth Bothra. So clearly those ideas are starting to contribute, and resultantly the fund overall has been delivering a decent alpha in the last 6 months. If you look at the detractors to the board, Titan and KFIN, and a large part of the KFIN correction was also led by a large block which done recently, nothing to do with the fundamentals per se. To the good and clean. Yeah, so good and clean, if you look at the 1 month performance, it's up about 1.7% versus overall flattish. So there has been alpha as far as good and clean is concerned. In fact, if you look at the last 3 months of performance, good and clean has really done well with a significant alpha generation of close to about 2.5%. So clearly, good and clean has seen a significant turnaround in the last 9 to 12 months, led by a lot of new idea generation, which has happened in the last 9 to 12 months. If you look at the monthly performance, and the top performers being Balkrishna, TVS, and Ajanta Pharma, of which Ajanta Pharma has been a new addition. So clearly, that stock has also started contributing. In terms of the detractors, were Aarti Industries, Deepak Nitrite, and PI Industries. So as such, the chemicals as a sector hasn't been doing well over the past 8 to 9 months. And hence we find a lot of chemical names in terms of the detractors, but we believe the next 6 to 9 months, the chemical as a sector should have by valuations being fairly attractive, and also to some extent the bottoming up of prices as far as the realizations are concerned. Moving on to emerging giants. So if we look at the 1 month performance for the emerging giants, it's been fairly unsatisfactory at close to minus 4.5 versus 0.8 for benchmark. So clearly emerging giants did not do well in the month of May, but in June, so far we've seen a good performance led by quality companies coming back into flavor. Obviously, Siddharth Bothra will take you through what has been the change in trends post the election. So I think in June, emerging giants is up about 10% so far. And as a result, since April, there has been an alpha generation as well. And that's been the case across all funds. So since 1st June, things have changed materially. So I'm not so sure if this May performance has a lot of importance to that extent. In terms of the top performers for emerging giants in May, it was led by Garware Technical Fibers, Suprajit Engineering, and Orient Electric. These names saw very good performance in terms of results, and that has led to a significant outperformance from these companies. The detractors being Raj Ratan Global Wire, Moltec Packaging, and Team Lease. Obviously, we'll have more discussions on stock specific during the Q&A session, but this is the overall summary as far as emerging giants is concerned. If you move 10x, 10x in the last 1 month, the performance has been -1 compared to 0.8. But again, 10x has done well in the month of June with a return of close to 8.3% so far versus 4.6% for the benchmark. So clearly, I mean, 10x has also started firing in the month of June with quality again taking more importance versus some of the value or the less quality names. In terms of the contributors, it came in from Garware Technical Fibers, Metro Brands, and Cholamandalam Investments. And in terms of detractors were Go Fashion, India Mart, and Orchid Pharma. So now I invite Siddharth to maybe take you through our newsletter, which was fairly well written. The change in the investment style as far as the rest of the financial year is concerned. Over to you, Siddharth. Siddharth, you are on mute.
Yeah. Oh, so sorry. Thanks, Bhargav, and good evening, friends. I'm delighted to be able to share our newsletter with you all. In this newsletter, essentially, we have covered three things. One is we have covered our thought that the quality as an investing is coming back. So essentially, we have discussed the return of quality and what are the things which are leading to that. Yeah. So maybe we start off with this. So these are the 3 points we have discussed, which is return on quality, and the other one is the snowball effect on investing. When we say snowball effect on investing, we are linking it with our investing style, which is more quality focused and more long-term investment mindset. And we argue here that unless you bring in these two elements, you will not be able to create the snowball effect on investing. That is, the magic of compounding that is needed to create wealth. And lastly, we discuss about Abbott India, which is one of our portfolio holdings, and we discuss how it's one of the best examples of a quality company which has the Lindy effect, which we discuss in this newsletter, and which we think is if we take our framework, it would be like a 10 on 10 kind of a stock. So we can move ahead. Bhargav, the next slide. Let's go in details. Yeah. So, we talk about return on quality. That is the quality outperformance is, what has led to the underperformance and why, how we think this is going to come back. So we argue here that, if you look at the market since 2021 till, say, last month or, the last 3 years, this market has been characterized by a very high beta rally, a retail-led participation where a risk-on sentiment has been there. And we have argued that this phase is very similar to some of the prior phase we have seen, say, between 91 to 94 or 2003 to 7. And, even I would argue, say, between 2015 to 17, when we saw, strong surge around mid stocks. Our sense is that we are already seeing several signs of this, kind of turning around. And, we've already argued about it in our past two newsletter. And to that extent, I would actually say that, the shift towards quality is already there. If you look at the last 5-6 months across quality names, these companies have come back in a very strong way. Whether you look at quality names like iShares, Avenue, you look at Bajaj Auto, so many of the stocks that we ourselves hold, and these companies have come back strongly. So when we say the quality coming back, return of quality, we are focusing more on the quality outperformance. So one of the reasons people have not noticed this quality coming back is still that you have many other sectors and so on which are doing so much better that in terms of performance, quality is still lagging, and so it's not come in everyone's eyes. Our sense is that as we move forward from here, particularly because post elections there's a policy rehash. We think there will be a sharp shift towards bringing up the bottom of the market, or trying to make the rural market recover. And this will then lead to a sharp shift in the market focus also towards stocks on the consumption side, essentially companies which have high ROEs, high margins, companies which are asset light, and companies which essentially create free cash flows and so on. So in this table, if you see, what we are trying to point out is that there is this study done by Kenneth French Data Library, where they give you US data. So one of the problems we have in India is a lot of the data we have for some of these factors, we don't have it for 20-30 years. Hence the reason for taking US market. So they have done this study from which is a 10-year rolling return performance for 35 years. And they clearly show as to how quality outperforms in the maximum period. And the second line, which is the best outperformance, and here you notice that during expansion phase, quality does not do as well as some of the other segments. And when I say the expansion phase, this is the phase which is like say 2001 to 4, or 91 to 94, where market is in a complete risk on rally. And the logic behind is very simple. When you saw the fall in 2020 post COVID and so on, quality names, many of them hardly fell, or they fell 10-15%. So on a rebound, they don't go as much as say other companies which would have fallen 40-50%, or their financials were so majorly impacted that they see major turnaround in the next 1-2 years. And then this momentum continues for another 1-2 years, and you see this kind of a divergence happening between quality stocks and say maybe companies which are more asset heavy, more levered, and companies which essentially don't have much FCF or ROE to show. The table below shows you which are the 4 phases that a market typically has, which is recovery phase, expansion phase, slowdown phase, and contraction phase. What data shows is that in most phases, quality outperforms, other than the expansion phase, which I mentioned to you about above. And our sense is that this phase now is behind us, and as we go ahead, you will see quality starting to outperform. Next slide, Bhaanu. So, here we're trying to explain as to what has led to this quality underperformance. And we argue that the reason for this quality underperformance has been largely due to, the so-called outperformance, as I mentioned, of some sectors, some segments which you typically avoid. So let me explain what I mean here. At our Ambit institutional research, we carry out a study where, based on the accounting quality and the ESG factors, which is which takes into account your governance things, which takes into account your sustainability, and how exactly say a company's past has been, and your leverage and so on. And they divide all companies. So this study is based on the top 500 companies. They divide the companies between decile 1 to decile 10. Decile 1 being the best companies, and then the quality keeps coming down to D10. So one of the things in investing is that you avoid the companies in D7 to D10, because what happens is that there is a real chance of capital loss here. And as you know, Warren Buffett's rule number 1 is that don't lose your capital. So the whole focus for a traditional fundamental analyst is to avoid these companies and focus on companies which are in say D1 to D4. And this data here is for the median 5-year return before COVID. And even if you go 10-year, 15-year, you will see the same pattern. That is, companies between D7 to D10, they underperform. Whereas, companies between D1 to D4, they outperform in a big way. But what we have seen in the last 2 years is that the companies which are in the D9, D10, they have actually outperformed. And this has led to the quality underperformance, which is what I mentioned happens during the expansion phase, where companies which are asset heavy, companies which have low ROE, companies which are very deep cyclical, they tend to momentarily for 1-2 years do very well. And this thing again, as I argue, is now behind us, because when you look ahead, when you look at the earnings growth, when you look at the kind of change happening in many of these stocks, it's no longer as remarkable as the period between COVID low and the 2 3 years post that. Now earnings growth for quality or the large caps is actually going to be higher. Here we also show you as to how there is severe risk in the low quality, or what we call some of the speculative and junk stocks. Like SMID is a very large segment. You talk about 2,500 companies here. So obviously it's always possible to have 150 companies which are great quality, but we are talking of this as a group. So just to keep that in a just to keep that in a context. So SMID share, this graph is nothing but all the SMID shares on a free float market cap divided by the total market cap. So if you look at the earlier peaks, which was in 2008, then in 2018, the SMID as a percentage of overall market cap was sub 30, 28 here, 30 here. If you go back further down, it was 18, 20. As we sit today, it is almost like 34%. So there is major exaggeration, there's major excesses happening in this segment, which one should be wary about, because what we have seen is that whenever something like this happens in the next immediate 6 months to 1 year, the mid cap and so on, I mean the broader segment as such underperforms by almost 20 to 25%. And the exhibit 8 is explaining you the point I mentioned, that while if you look at below the Nifty 130 quality index, it's done 34%. So quality is already back, but the outperformance is not visible, because if I look at the last 1 year, the reality index did 110%, the PSE index did 100%, the momentum did 70%, the energy did 70%. So these sectors did so well that this is not visible. Now most of these sectors that you look here don't have a history of wealth creation. In the best of time, they don't make ROE more than cost of capital, and this is not a space where you can create sustainable long-term wealth. So we think that this segment outperformance that you've seen in the last 1 year is not sustainable. And what you will see when you look at on a 2 year, 3 year basis is quality come back in a strong way. Next slide, Bhargav. In this newsletter, we have tried to explain what we have seen in the last 2 3 years on the basis of behavioral bias. Like behavioral finance is the best way to understand some of these things which happen. And we have used a research paper which talks about a long short bias. The author here describes that what a long short bias is and what they are seeing here. So as per him, a long short bias describes the tendency of people to overpay for opportunities with a very low probability of success, but a very large payoff if successful. That is, your probability of something happening is zero point 0.2, but if it happens, one can go to 10. Those are the kind of things which somehow attracts some kind of investors. So here they give you an example of a racetrack. Empirical evidence shows that everyone who bets in a racetrack loses. But the important thing is, it shows that if you bet on a horse which is already winning for some time, or a horse which is known to be winning, you lose only 6%. But if you were to bet on an outside horse where you don't know anything, but you think it might win, and the odds are like 1:10, you end up losing 60% of the time. So what they argue from this is that we are seeing similar things in India with regard to FNO, where the regulator again and again points out that 95% of the people lose money here. So this has similar implications to what's happening in racetrack. And why I'm comparing it is because it's unprecedented, the kind of FNO kind of trade that happens in India. When you compare it to global, the multiple versus our cash market to futures is almost 7 8 times as to what it is in globally. So that's the kind of excesses that we are seeing here. And lastly, to summarize, there's this professor called Alok Kumar who wrote a paper which talks about who gambles in the stock market. He found that at an aggregate level, individual investors prefer stocks with lottery like features, and a lottery demand, and a demand for lottery type stock increases during economic downturns. It's very important. What here he's saying is that, individual investors look for companies which are like a lottery, like in 1 year, how can I make it 2, 3, in 2 years, how can I make it 5 times? Or, in a downturn, the lower the net worth, the higher the tendency to do this, because they think this is their way to create that wealth to meet the requirements they have. This is not a tendency you will see with people who have created wealth and are looking at, how do I sustain my wealth? How do I grow it in a sustainable way? Because, there the capital protection is first, because it's hard earned money, which means something. So this, is why I'm talking this, is because, everyone knows that in the stock market, the prices are determined by the marginal buyers, the guy who's the marginal buyer. And today the marginal buyer is the retail investor. So these features, if you, on the behavioral side, if you understand, it gives you a sense in understanding what's happening in the market today. And he concludes by saying that the retail investors prefer stocks which have high skewness to returns, greater unexplained volatility. Basically, they like small companies with cheap share prices. So this I think, if you read this paper, which is on the long short bias, it gives you a very good sense of, what's happening in the market in the last 2, 3 years. And he explains it further by talking about the availability bias. The reason this happens is because people overestimate the probability of these long shots. Like, you still see many people today talk about how there's a 10, 15 rupees stock and it can become 60 rupee. And there is always a story which shows how it can become. But what is the probability of this happening is so low that, if you multiply the probability with what you're expecting, the returns are so low, you're better off, investing in a proven quality company where the probability of that happening is very high. Next, this thing. So in this newsletter, we go on to talk about how to create this, the snowball effect on wealth. And here we argue that, if we understand this concept of Lindy, it will help us a lot. So I'll come back to, I'll start with what exactly is the Lindy's law. So if you see, Lindy's law was popularized by Nassim Taleb. You all must be knowing, he's written many famous books like Black Swan, Anti-Fragile, Skin in the Game. So what he essentially says is that Lindy effect is an observable phenomena that provides insight into the survivorship of non-perishable, intangible items such as ideas, technologies, companies, cultural works. To give the definition of same, the Lindy effect is a concept that the future life expectancy of some non-perishable things like a technology or an idea is proportional to their current age, so that every additional period of survival implies that a longer remaining life expectancy, that is, अगर कोई 100 साल कोई company रहा है, so there's a chance that, it may live another 100 years. To let me give you a sense as to how he derived this. So what he did, he came up with this thing from the example in New York Broadway. So in a Broadway, he said that, whenever a play is launched, there are very few plays which are successful. But, any play which goes on for, say, 200 days, 300 days, there's a chance that it will last for another 200 days. Whereas, so, this is where this Lindy effect came up. And why it's important for us is that, when we are buying companies, if we try and buy some of these companies which have Lindy effect, what will happen is the longevity of these businesses are so high that, investors are most of the time not able to value it properly. And that's where you have margin of safety, and that's where you have a very high upside. Next slide, Bhargav, come to this in detail. So I have here given some examples in this newsletter of some companies which have very high, which have the Lindy effect. So what I have done here is I have taken companies which have more than 30 years since, age since incorporation and since listing both. So there were many other companies, but I just put a filter further with regard to ROE and growth. So, this list come down. So if you look at a company like Indian Hotels, so, it's already a 122-year-old company. It's been listed for 36 years. So it gives you a sense that when you look at growth here, this company has a life of maybe another 100 years. Whereas in most analyst model, when they value it for the next 10 years, and then they assume that, at a GDP rate, it will grow in the terminal way. So this is, if you understand this Lindy effect, then, especially growth stocks or companies which have a very high longevity, you will be able to value very differently. So if you look at companies like Britannia, companies like Berger Paints, Lende India, companies like Abbott India, the one which we'll be discussing in detail, Mahindra, Asian Paints, PI, ABB, all this trend, all this falls in that. They have, like, if you look at the case of Trend, it's a 72-year-old since incorporation, and 36 years since it's listed. So, it's probably has another 30, 40 years at least of growth ahead. So when you value these companies, if you understand Lindy effect, it will help you significantly. Yes, next slide. And for this point about creating the snowball effect on investing, I would like to conclude with this point, which is that short termism is the bane of successful compounding. So we all know that, the magic of investing is in compounding. That is, if you buy some quality companies, let it compound for 5 year, 10 year, and then it creates wealth. So there are two ways you can, look at investing. One is income generation, where you just focus on, I bought this thing, it went up 50%, I sold this and did this. And, doing that, you can maybe, create a lot of income. But if you want to create real wealth, then, you have to let your money compound. To give you a sense that, if 10 years your money compounds at 25% or maybe 26%, then in 10 years, 100 rupee becomes 1,000. And, for the next 10 years, if you're able to do that again, that 100 becoming 1,000, it multiplies by another 1,000. So, essentially 10 rupee becomes 100, and 100 becomes 1,000. So, it becomes almost like 100x. So when you talk of creating multi-baggers, if you are a really long-term investor, you will talk about creating 10x, 100x, not like how can I double my money in 1 year, 3 months, 6 months, because those are more like income generation kind of a thing, which will not create the long-term wealth that you seek. And I have put that down as to what are the factors which impedes compounding. The first one is next quarter, which is, trying to understand what will happen in the next 3, 6 months instead of thinking what will happen over the next decade. Focusing too much on stock price movement, like most of the discussions, you will see people who are not long-term investor will be focused around the stock price movement. ये stock 100 का 150 हुआ था, अभी 120 हो गया. ये stock तो for a long time 120 का 130 हुआ है. They don't talk about business fundamentals, but markets in the long run discount business fundamentals. Then there is a lot of focus on action rather than thinking. Like, okay, if budget came before budget, why didn't you sell? If budget is good, then why didn't you buy this? Rather than thinking as to what will really create wealth, and why not doing all this could be in long term benefit. Comfort of crowd, asset gathering, and lastly relative performance versus absolute. Like, focus on what is your focus on a long term absolute wealth creation target, rather than trying to beat markets on a 1 month, 2 month, 3 month. Next slide. So now we come to discussing about one of the companies which we really like, and is part of the coffee can and in some of our other portfolios as well. So Abbott India, if you see, is, as I mentioned to you, it's almost like a 70, 80-year-old company, been listed for 36 years. It's an innovation focused MNC company. And, though it's a pharma company, it has all the characteristics which are like a consumer company, financial characteristics. So let me start with, discussing about with the sales, PAT and ROE. So if you look at on a 10-year basis, compared to all these companies here, which is Asian Paints, Dabur, Nestle, Britannia, Marico, this Abbott has had higher sales. Same for 5 years, same for 3 year. And if you look at a PAT, they have got the highest PAT CAGR, which is 21%. On a 5 year, again the highest. 3 year, again the highest. And even the ROE here, it's going from 28 to 36%, whereas for most of the companies other than Nestle, the ROE is coming down. Like for HUL, if you see, 100 is becoming 20. For Asian Paints, 33 has become 32. For Dabur, 24 has become 20, and so on. So, we think instead of buying consumer companies, I would like look to buy Abot as a proxy to consumer because it has same characteristics. It has 10 brands in which, it is number one or number two in almost nine of them. And, this is a business where the distribution strength has not, I mean, the distribution play has not yet played versus, say, some of the other consumer companies where the distribution part of the story is already been played out. Even when we compare Abot with other domestic companies, I think the key thing to look here is the 5-year, 10-year capex. The capex to OCF for Abot is only 4%, versus if you look at the other companies, most of the growth in other domestic pharma companies is because they have done some inorganic acquisition or they've invested in a big way in R&D or a big way in their plants. So this is a play which is similar to a consumer company which is growing on a brand, and which is all organic growth, not bought or inorganic growth. So only in a bull market will you see that a company says I'll do inorganic and I'll do some take huge debt and do inorganic thing, and markets will give it high P. Typically that's not the way you create wealth. The wealth creation way is to do it through organic way. So we think Abot really stands out in that direction. Next one, Bhargav. So now over to you, Bhargav. I've kind of covered the newsletter and the 3-4 points that we had there.
Yeah, thanks, Siddharth. And it was really enriching hearing from you in terms of the fact that quality investing is starting to make a comeback. So let me just take you through the macro and market update. So clearly, the expectation was अब की बार मोदी जी की सरकार. But unfortunately, this time around, that did not happen, and it's now अब की बार NDA की सरकार and not Modi की सरकार. So if we look at 2014 and 2019, clearly BJP was the single largest party, and more importantly, they had the majority in Lok Sabha. However, this time around, whilst they are the single largest party, but unfortunately, they did not get the majority. And hence, NDA ki sarkar rather than BJP ki sarkar. If you look at a few of the large states where they saw disappointment, some of these states are Uttar Pradesh, Maharashtra, and West Bengal. So clearly, in fairly large states, their performance in the elections hasn't been satisfactory. And what it seems like the underlying reason for the poor performance is likely to be neglecting the as far as these states is concerned. So in the upcoming budget, which is likely to be presented in the third week of July, we believe that it could primarily be a populist budget and not ideally a reformist budget. And the main reason for that is the upcoming state elections in a few of the states, which I'll cover in the next slide. So if we look at a few of the states which are coming up for election in the next 9 months, so you have Haryana, you have Jharkhand, and you have Maharashtra, which are coming up for elections in the next 9 months. And then you have Bihar, which is coming up for elections in November 2025. So clearly, there are 4 large states which are coming up for election, and hence we believe that this time around the government will look at sort of accelerating the spending, especially on the rural side, in order to garner vote, and more importantly, in the state of Maharashtra, which is coming up for election as early as September. So you don't have enough time to sort of take vote share from the people in the state. In fact, Fadnavis is already visiting a lot of tier 2, tier 3, and for that matter, tier 4 districts and talukas to sort of create an expectation that possibly in the budget they'll be taken care of. More importantly, what could happen is that there could be some compromise as far as fiscal discipline is concerned. And two of the states, which is Andhra Pradesh and Bihar, could see increase in allocation in the form of special status, sort of a mimic. The reason for that being is that AP and Bihar are very important coalition partners for the BJP. So obviously, the government will have to take care of Mr. Naidu and Mr. Kumar and keep them sort of happy to ensure that they continue with leadership. So net we're expecting close to about incremental allocation of about 500 to 600 billion to both these states in order to mimic a special status. So clearly there is likely to be some compromise as far as fiscal discipline is concerned. In terms of policy, so clearly so far, last 10 years, we've seen significant reform-oriented policy framework as far as the BJP government is concerned. And clearly that has got reflected in the stock markets as well, wherein a lot of capex related themes seem to have done well. But if you go by the initial behavior, which is visible as the new government has come into action, we can clearly see that the government is trying to paint a fairly populist kind of a stance. So the recent increase in sort of allocation or I could say release of funds clearly on seems to be hinting that the government is looking at populism. In fact, we've seen a significant change in allocation in the last 15 days towards consumer discretionary, towards affordable housing. In fact, in affordable housing, there is a big expectation that this time around the allocation can see a significant increase. So clearly we are seeing some change in terms of portfolio allocation, and maybe themes which did very well in the last 12 months not be seeing similar kind of trends this time around. So clearly the budget will be really interesting to watch out for because if you look at the current stage where the markets are, still it doesn't seem to factor in a few of the decision making which the government may do in order to sort of please the masses, whilst the affordable housing space has seen some stock really rallying in the last 10 days, but a few of the stocks in defense, PSUs, railways still continue to do well. Will be important to see how they perform post the union budget. Next slide. In terms of rate cut expectations, it doesn't seem like either US or for that matter India seems to in a mood to sort of incorporate rate cuts sooner. So clearly, one needs to wait as far as the rate cut catalyst is concerned. It seems like maybe in the next 6 months, there are fairly remote chances of that happening. So unfortunately, the rate cut scenario doesn't look to be at least in the near term. Lastly, in terms of markets, so if you look at valuations for Nifty on both, clearly valuations seem to be in line with the last 5-year average. Our sense is that this financial year may not see a fairly broad-based kind of a rally year. Clearly, it seems to be a stock pickers market as far as this year is concerned. And a large part of that example we've already seen in what Siddharth highlighted. So clearly, FY25 will be a year where possibly funds with increased allocation towards quality could sort of cyclicals could see some underperformance, especially given that markets are no longer ultra cheap. So they are fairly valued. So clearly, the broad-based rally might take a pause as far as the remainder of the year is concerned. And to that extent, one needs to have fairly active allocation towards funds which have a large active share in the portfolio. And hence, possibly one can highlight that this year it could be a year where we as a fund might sort of do well, given our share of active allocation is fairly higher, and given our portfolio characteristics mirror very close to quality, which means negligible debt on the balance sheet, double-digit earnings growth, and earnings growth which is higher than the benchmark, and return on equity, which is significantly higher than the benchmark. So clearly, it seems like this will be a year where stock pickers should do well. This is what we wanted to highlight. We now open the floor